Joining us now to kick off our week-long State of Investing series is Mansco Perry, Executive Director and Chief Investment Officer of the Minnesota State Board of Investment. Thanks so much for joining us, Mansco. Very decent, impressive performance numbers there, not least with the size of funds you're managing. Remind us what that is, the overall amount of money you oversee at the moment.
Currently, we oversee about 130 billion, but of that amount, 90 billion or so is in our combined pension funds, which is what we focus on primarily, and that's where we achieve the 30.3% return.
And a big picture question, first of all, on the state of investing, Mansco. What level of fear do you have about the overall returns for markets when we see the massive stimulus that we've had, not just in the last year or two, but the last couple of decades, really, if and when that is removed and yields rise significantly? Do you think that will be a big blow to U.S. equity markets?
Yeah, that's the thing that we've been most concerned about and talked about. But if you look back in history, we still believe that even though you have quite a few equity drawdowns, that over the long term, and we're supposed to be investing for 25, 30 years out into the future, that equity markets, particularly in the U.S., seem to be pretty resilient over the long term. So if you've got patience, you're able to do this.
And what about your allocation to fixed income over the last couple of years? How has that changed? And how is it relative to your historical average positions?
Until 2018, we had pretty much had about a 20% allocation to fixed income, and it was primarily in core bonds, maybe a few managers core plus. But in 2018, I was able to change the portfolio where we were half core and half treasuries. That turned out to be a lot of luck. Treasuries over the next 2 years, I think in each period earned us between 15 and 20%. When the pandemic began, I had a lot of flashbacks to 2008, and my big concern was whether or not we would have liquidity. While we do manage a great deal of money, the most important thing that I am told to focus on is that we're there to mitigate our liabilities, and the biggest fear I've got is not having enough every month when it comes time to make retiree benefit payments. So we wanted to ensure ourselves that if this was going to be an extended period, that we were able to say that we had plenty of cash on hand. So we changed the portfolio a little bit at the last, started talking about it last May and June. And we restructured the portfolio such that 5% of it has cash and a short-term ladder. So we feel pretty comfortable in pointing out to our board that we wouldn't have to worry about pension benefits. 10% of the portfolio is in 5+ treasuries. We try to watch the duration there, but we consider that there for protection to ensure that there's liquidity if there is an equity drawdown, that one, we're able to continue business, but it also gives us a little bit to rebalance back if the markets are not right where we want it to be. And we kept about 5% in the core plus, and as the year began, we started adding about 5% into what we call return-seeking fixed income. That would be emerging market debt, high-yield debt, some secured, some structured credit, and the like. And the rationale behind that was given that we were near zero at treasury yields, that we needed to have something produced out of the bond portfolio. But the rest of the portfolio is very equity oriented. We have 50% dedicated to public equity and 25% target for 25% target for private markets. To the extent that we're not at our full 25% target, I think right now we're at 16%.